I'm Doug MacKenzie.
And I'm John Ward.
And we're the co-hosts of the ABCs of IBC podcast.
Come join us as we share our unique perspective on the infinite banking concept as the creator, Nelson Nash, intended.
Welcome back, everybody.
Welcome back to you, Doug. Welcome back to the mainland.
Yes, I just spent some time down in Florida, and it was wonderful. It was really nice to get away, be on the beach, and live the Florida life for a few days. Although it was funny, I was telling John, and I don't mean this to any offense to anybody that lives in Florida and loves it, but as someone that's been in New England all their lives, I definitely could not live in Florida. It's not me. Too hot, a little bit too fancy, and I was happy to come home.
Yeah, when you were talking about that, what was in my head was whenever my wife and I went on vacation with the kids when they were young, it just seemed like, of course you're on vacation. We'd always start saying, geez, let's look at real estate here, let's buy something, like let's move here. Because, of course you're on vacation, so everything's grand. But we had rented we had we have three kids, and so it was five of us and all our stuff. And I rented an old Cadillac. Well, old, it was newer then, but it had a huge trunk. And we did, with family members, rent a house, and then there was a pool. I think probably similar to what you described. There was a pool downstairs, and this rental had all these bikes, and we could take a bike ride down to the ocean, which was only like 7 minutes. So we started our day like we were in heaven every day. That jump in the pool after a run or a walk or whatever, and then take a ride down to the ocean and hang out there for a couple hours. And of course, let's move here. Let's look at real estate. We should invest here and all this. And then one day we decided we needed to take the bikes further away, and we were going to put the bikes in the car and then drive. And just putting those bikes in the car with clothes on, we were no longer, I don't know why, but we were dressed up a little bit more. And
you're sweating through your clothes.
I said, no way. Yeah, I forgot. Oh, yeah, living here would be like dealing with this heat all the time. And I have a brother who's lived there since he was 18. And he's not a sunbather. And he talks about the heat being unbearable at times. But
it's humid. It's like soup.
Yeah, like soup. Yeah. Sure. Yeah. So everybody probably that's been to Florida kind of can understand what we're talking about. So anyways, it's nice for a short trip anyways.
Definitely. Yep.
Yeah. So today,
well, we're going to talk about, and we've talked about this across other episodes, but we were talking before the show, as always, about things that we're still hearing a lot, objections that we hear about doing this, about whole life insurance. And again, this got brought up in John's life. Again, this objection that, oh, no, you shouldn't buy whole life insurance. If you're going to buy life insurance, make it just about life insurance, buy term. It's the cheapest. And it's a bad financial move to put any money into whole life insurance. And we just kind of put our heads in our hands and go, okay. Because usually this is said by people that quite literally have no clue about whole life insurance. And I mean that truly. Have absolutely no idea how whole life insurance works from a mechanics level, any of the tax benefits, how it's classified. They have absolutely no idea how it works. And they're parroting advice that they've seen or heard somewhere. And that's as far as it goes. And it's kind of scary. But anyways, we thought we'd delve into that a little bit, as I'm sure that our listeners are bombarded constantly with that same advice.
Wow, that was really a good recap of where we're headed. The parroting. We don't know what we don't know, and especially if we're the so-called non-financial person, even though, this all started by a conversation I had with a new client who's a business owner, so he's got to be financial in some way to keep things afloat and cash flow management and all that. But yeah, there's financial advisors. Obviously, many of them don't know anything about this. They do know about term because that's the thing that's pushed so hard out in the marketplace. And there's a reason it's pushed so hard, because it's such a so-called cash cow for the insurance companies. It's a money maker because they rarely pay out on it. And so it's just money coming in. It's quite nice to have money coming in and never really have to pay out. So, this new client, it's right. Okay. So we start with people who start investigating this and may start talking to their peers, friends, family, whatever.
Or a
And because
financial
people,
advisor.
well, even just talking about it to people, never even, yeah, never mind you're a financial advisor. And people are like, oh, geez, uh, even people that say they hear something about the infinite banking concept, they dive in a little bit and they're just saying, this is really, it can't be true. It can't even be true that this is how this works, because it's got to be a scam. There's got to be a catch, because not many people are doing it. I've never heard of it. And so you've got all that. And if somebody makes the move to, go through conversations with people like you and I, Doug, and practitioners that understand it, that understand the infinite banking concept, how to implement it, they eventually, through their own confidence, decide, yes, I'm going to do this. I'm going to now forward to, they've made this decision, they've got a policy, they're pretty excited about it, some of them. And so this new client of mine likes to start talking about it to people. So he runs into a gentleman who was this guru. He had every credential you could imagine. He did all kinds. One day he said he handed him like 10 different business cards of all the specialties. And one of them was, he was a life insurance agent. He was a financial advisor, investment manager, all this kind of stuff. And he ran into him for the first time in like 6 or 7 years. And he starts to share what he's doing. Now, this gentleman's in his 80s, for what it's worth. And, obviously astute, smart, capable. But he immediately said to him, when he said, I'm going to start, I'm going to borrow, against my policy, do this. Then and the guy was like, no, 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 don't do that. That's your life insurance. If you die, your wife, she has nothing, meaning, well, if you had borrowed all your cash value, you're still going to end up with some death benefit. But of course, there'll be less of it because you've got to take the loan balance off of the death benefit before you pay the beneficiary. But he was like, no, no, keep that separate, invest your money in mutual funds, and let's get on a call with Charles Schwab and say, you want to invest in mutual funds, take your tens of thousands or whatever. He's already trying to talk the guy out of what he's doing with his policy. And to his credit, though, the client, he stood firm and he said, no, no, this is what I'm doing. And started to try to give him more information. And the guy ended up saying, oh, I must investigate this, And he had an accent, but I'm not going to do it justice. So, but I'm changing my voice a little bit. But So he's going to read the book, and then they're going to, reconnect, and who knows where this guy's going to go with it. But this idea that you should always just buy term, well, yeah, income protection is great, and I would never say don't cover yourself for, hey, if you're gone, you can't produce income anymore, and your family's probably going to suffer, or there's got to be a shotgun wedding so somebody can connect with somebody else who's got money. I don't know. So, all these things you might not wish upon those that you love to suffer. It's bad enough you disappeared for the rest of their lives, but that yeah, there'll be some strife with the income or lack thereof. So I never would say don't cover yourself for that, but that's not what we're doing. And that's what this is, becoming your own banker, creating your own banking system. So it's two different animals, and people don't see that. So
Right, exactly. And Nelson makes the point that we were like, man, where's the page for that? That if you are practicing this the way that it is meant to be implemented, by the time you pass away, you'll have so much death benefit, no matter how many loans you take out. It would be more death benefit than the insurance company would ever have underwritten you for in the first place. And Nelson
right,
talked, and that's exactly what happens because unlike term insurance, where you have a static death benefit, and by the way, to keep this in mind, if you get $1 million term policy when you're 25, right, that is worth a whole lot less in future dollars when you're, 55. Let's say you were to die when you're 55. It's going to be worth a whole lot less to your surviving, heirs, whoever that's paid out to. Whereas with whole life insurance, you have a continually growing death benefit. But the point is, if you're practicing this for the purpose of capital allocation, using it to buy cash flowing assets, make large purchases without relying on a bank, and you're continuing to grow through additional policies, which most people do, you're going to wind up having more insurance at the end in terms of just death benefit payout than you could ever get in a million years with term insurance. And over the long run, it's going to be drastically cheaper because it's actually going to pay out. Most people don't consider that. John mentioned that in the beginning that, oh, term insurance is cheaper. Yes, it is during the times that the life insurance will actually reasonably afford you. And those are the times when you can look at the stats, somewhere between 1 and 4% chance that you'll get paid out. It's very, very low. You're almost certainly going to not get any of that money back, which is a good thing, right? We don't want to die early. But if you want to start looking at having death benefit protection in those later years post age 60, 65, it becomes really, really expensive to put that in force, like really expensive. And an interesting example, we were just looking at, I pulled up the illustration for when we put a policy in force for my son. And he was 4 at the time. Actually, sorry, he was 3. Um, and when we look out to, let's say age 70 on that policy, he'd have, $4 million in death benefit. What do you think it would cost to get term insurance for $4 million at age 70, John?
uh, well, for most it would be totally elusive. I can't even imagine what that number is. It's got to be hundreds of thousands, probably
Yeah,
hundreds of thousands.
it would be really, really, really prohibitively expensive. And for him, it'd be $6,000 a year. Right. But that's because it's been locked in at a young age. And he will have, at that point, if dividend scales remain how they were a year and a half ago, close to $3 million in cash value. But it's just an interesting thing that most people don't take into consideration, that the death benefit protection is actually far greater with whole life insurance, while providing you with those additional attributes that we talk about on here so frequently.
Yep, yep. And again, yeah, back to your point of not paying out. I mean, they typically, whatever the number is, it's been bantered around and we've talked about it. 98, let's just say 98% of the revenue that comes in, and 98% of the policies never, there's never a payout from the insurance company because they either lapse the policy by stop payments or the term runs out. And so it's just a sheer
Correct.
moneymaker. So that doesn't benefit the consumer or the policyholder. It gave them this maybe some peace of mind, even though it just felt like another expense.
Well,
Peace of
yeah,
mind that
it does provide a benefit in that if something, it's like a car insurance or homeowners insurance. You hope you never
exactly.
use it, but if you have to, it's nice that you got it, right?
Yeah, nobody loves paying their car insurance really if it gets big enough, right? I mean,
No,
right? You kind of feel the same. But yes, you do know that that's smart, right? In case something does happen, because stuff does happen and people do die. So yeah, you feel better that you have it. But there's a reason, as you've said in the past, there's a reason why it's so inexpensive,
of
right?
course.
Because
It's
they're insuring people that are likely not going to die
it's all
during the term.
it's all statistics, and there are no better statisticians anywhere than life insurance companies. Like, they are literally the best out there. A lot
I
of
agree.
people rely on their mortality statistics and understanding of human lifespans and stuff like that because they do the best research. Their industry depends on it. And I always chuckle when people say, "Oh, whole life insurance is a scam." That's they're ripping you off. Well, not really. They're actually ripping you off with term insurance. And again, not to say that term insurance is bad, but they're making a crap load more money off of you with term insurance than they are with whole life insurance. And I'll tell you that it's not even close. It's not even close. Um,
Well, because in these structured policies that we do with whole life, that the life insurance coverage, the death benefit continues to grow, um, then there's no real reason not to, if you needed some additional coverage beyond the whole life insurance to protect the income for, say, 30, 40 years or 10 years or whatever it is, whatever age you are, um, that as your whole life death benefit increases, then you can drop off the term. Like you may decide to you have a 30-year term policy, but you may stop at year 15 because now you have the coverage, or you may convert it if it was convertible. I always say if you're going to buy term, you better make sure it's convertible because then
yes.
you can create another whole life policy out of that, and you only have so much time to convert it over the term. But yes, I mean, even the term policies that we put on with these infinite banking based type policies, yeah, that those are convertible. So
Yeah,
we
but
get in.
most decent insurance companies by default have some sort of convertibility in their term. And if you're
Yeah.
like, if you're buying term and it doesn't have that, I just the difference in cost to have a policy that's convertible is like negligible, and it would be very short-sighted not to have that, in my opinion. Um, the other funny thing that I hear people say is, well, at a certain age, because you'll have put so much money away and it will have compounded at whatever ridiculous compound interest rate they throw out, 12%, which nobody gets. You'll have so much money that you won't need death benefit coverage. Okay. Okay.
Yeah.
So the funny thing about that is most people assume that by the time they're 65, they're going to have, millions of dollars because they've been socking money away. The reality is most people don't adhere to plans the way they think they will, and things don't work out the way they think they will. So by the time they get to 65, perhaps they're not really ready to retire. It's not financially secure for them to do so, or they need to work a little bit longer, or if they do, they need to live on less money than they thought they would. And their spouse or kids really would not be all that protected from a death benefit standpoint if they were to pass away. There aren't really enough assets there for their spouse to live without working.
Yeah.
And the problem is at that point, you're screwed from a life insurance perspective. There is no way at 65 or 67, whenever you think you're going to retire, for you to go get an affordable term insurance policy. It's just not going to happen. You can get it if you're in okay health, but it's going to be prohibitively expensive, way more expensive than whole life insurance premium payments would have been. And if you can implement a whole life insurance policy from a young age, like I look, again, we talked about the power of child policies. I look at my son's policy. When he's 70 years old, the premium is exactly where it was when he was 3.5, $6,000 a year. And when you look at the dollars, when he's 70, we look, out that far, $6,000 is going to be comparatively much cheaper than it is today. And in my world, it's not that expensive for what he's getting right today. But if you look out to when he's 70 and you look at how money inflates, it's going to be very, very cheap, almost a negligible amount of money to pay to get an extraordinary benefit that's just going to grow with him and his family. And if he's any sort of good, practicer of IBC, as I hope he'll be, as I plan to teach him about that, he will probably have additional policies. And as my wife and I's life insurance holdings grow, we will likely get additional policies on him as well before he's 18 or later in life. So that death benefit amount that I mentioned previously of, around 4.5 million will be higher than that with other policies, right?
Yep.
And that sets up this system to where you have these large sums of money that are going to pass down intergenerationally without the government ever getting their paws on it. And so well, it's really important because what happens to most people, like I mentioned before, is they save, 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 save. Maybe things go well and they can retire when they're 65, 67. And then they have enough money, usually with Social Security mixed in, to die, hopefully without running out of money, and they leave very little left. And so, and that's hopefully what their kids do. But nothing's being passed down. And if it is, it's being taxed, and it's a headache. And this is a system by which that death benefit protection, which is usually viewed as an expense that you won't use, is actually a tax-free asset for your family. It's going to drastically change the outlook of your kids and your grandkids.
Mm-hmm. Yeah. Yeah. I mean, I don't, these are very old, like mortality tables. I wanted to state a couple things. One is, right, even if you could get some coverage that was beneficial on term insurance when you're 65 or so, the fact is you have to be insurable, right? Yeah, you have
Correct.
to be in good health. And of course, as people age, there's a lot of different conditions that can make you uninsurable or substandard insurable, which means that your costs are going to be even higher. So,
Right.
and you only have so much cash flow to pay for it. So then it just limits the amount of coverage. So it really is, of course, it makes sense that like in the book, he uses an example of 1,000 Americans, and I kind of think about his sense of humor. He puts out of 1,000 Americans born, he puts 1,000 will die. But this is back in 1958, so I'm not pulling out any new mortality tables. Of course, we know that people have been living longer since 1958, but let's just even say then that people, there was 75% of those 1,000 people would still be alive at age 65. So people, they already know, right? Again, back to these engineers of these policies, these actuaries, they already know people are going to live. On average, most people are going to live until they're 65. I mean, just most people are going to do that. 3/4 of the people are going to live that long, at least. Even back then, I'd say it's higher now. And we could say what the life expectancy is, and we could throw around male and female, but let's just say it's 80 years old. I mean, what he states at the very, very beginning of, it's called the introduction of the book. He says this book demonstrates that your need for finance during your lifetime is much greater than your need for protection. And back to this income protection with term insurance or any kind of life insurance. But this is the piece that my client's old friend in his 80s, doesn't take into consideration because he doesn't know this about life insurance.
Mm-hmm.
Doesn't, he may know something about the fact that you can borrow against cash value in a policy. In fact, Nelson says most everyone is familiar with the fact that you can borrow from a whole life policy. But because of how little premiums they pay, right? They don't put much in. There's limited access to money to finance major items during a lifetime. Yet the need for financing for the typical person is extensive. And where I'm trying to tie this together, Doug, is if most people are going to live to 65, I can tell you most of the financing that you do in your lifetime happens 65 and younger.
Correct.
So you're going to live. So we're not necessarily focused on the death benefit or the need for protection. We need to understand how much financing we do in our adult lives from the age of, say, 21, which is how he talks about it in the book, to 65. That 44, 45 years is, it's crazy how much financing you do. Think about all the cars you buy, all the expenses you have if you have children, all the credit cards, all the refinancing, mortgages, moving the house to house, starting all over again with mortgages, right? So you're paying at the high end of the interest side of it. I mean, it's a huge chunk, and people don't think about the fact that, hey, can I control that financing function in my life? Well, they don't think that way because nobody's ever talked about it. And even financial and wise people that you might lean on and go, geez, they know finances better than me. They know investing better than me, right? Because I'm a mechanic. I'm a, whatever. This isn't my specialty. Or even the ones that think that they're, lay people that think, hey, I've been studying all these people, I've been following these gurus, and I think I know. But unless those gurus have at least investigated the concept of how much financing you're going to do throughout your lifetime, and can you take back control of that function, then they need to sit down and read the book. They cannot just comment without investigating.
Anyone that I've talked to if I kind of just, and I don't make it a point to get into like confrontational discussions with people. I just kind of like try to find out more about why they think a certain thing. Anybody that's made disparaging comments about infinite banking or whole life insurance, if I kind of press a little bit further, every single time it has turned out that they know absolutely nothing about it, and that they are just like, that basically it comes down to, I heard it's a bad idea and I don't know anyone else doing it. Oh, okay. Sounds good. It comes from a narrative that's been in place for quite some time. We've talked about that, buy term, invest the difference. Dave Ramsey is someone that parrots that quite a bit, and that guy makes a lot of money selling term insurance. So he may or may not have a vested interest in what he says. um, but it's just kind of interesting, and it's a little bit frustrating. But that's what I thought for a long time too. And until, I don't really know why I did it, until I just one day kind of sat down and looked into it a little bit more and just looked at the facts and put things out on paper. I'm like, oh, this actually makes a lot of sense. Um,
Really
but it's
does.
hard to get people's minds to open up like that.
I spoke with
Yeah.
a new prospect last night, and she says, "I really think I'm getting it. I'm reading the book, um, and then of course as we kind of reconfirm what she thinks she already understands, and she's like, yeah, yeah." And I was just looking at the book this morning, and I was like, it's as if she was just repeating what he wrote, because he kind of uses an example. He says, "The fact that the principles have been there all along and no one taught them to me makes me rather angry." And she did kind of say those types of things last night, like, that makes me mad, like that. Why didn't anybody ever tell me? And I had to keep repeating, well, it's not beneficial for those that are benefiting right now from not telling you to tell you, because then the jig is up, as they say, right? So, um, but then it goes on to say, had I known them, the principles, that is, had I known them, life would have been much simpler and much more profitable. Someone should have recognized them and taught them long ago. But this didn't take place because of the mindset that predominates in the entire financial world. So back to
Mm-hmm.
my point, that even those that are supposed to be the experts, if they haven't, spent some time here, and if they can be unbiased. And the problem is if one of the ways you make money is to get people to pour their money into mutual funds, or
Yeah, I
what.
was just gonna say the same thing. It's tough to have a financial advisor because most of them are assets under management as opposed to fee based. That's gonna go, sure, why don't you take that money that you could have given to me, and I'm gonna make a percentage of it, no matter how it performs, or you could give it to something with guaranteed growth and all that kind of stuff, but I'm not gonna make any money on it. It's a tough sell, right?
Well, yeah, right, exactly. And I guess somebody could try to flip that on to us and say, well, geez, because you don't do this, you don't sell mutual funds. Well, no, I don't. I'm not licensed to. But if I thought that that was the right thing, and that was, hey, that's clearly the best thing to do, it's the only solution, um, then I would go out and get my Series 6 and Series 7, all that kind of stuff, so that I could sell
Uh,
these
I'm this.
securities.
Yeah, I have absolutely no interest in doing that, and there's nothing wrong with mutual funds, but I realized I had a financial advisor years ago, super nice guy, and at some point I went, this is weird that I'm paying this guy thousands of dollars a year, like even when the stocks that he's buying or the mutual funds go down. Like that doesn't make any sense. I just don't, so um I feel very good when I can sell somebody and provide them with a policy that I know is going to compound at a very given guaranteed rate every year and provide contractually guaranteed results, right? I feel good about that.
Yeah, and that you're allowing them to always have access to a capital pool that they created by doing this. And back to this point, we know that over our lifetime, the need for financing is going to be much greater. And I say our lifetime, the bulk of our adult lives is going to be much greater because the protection, just like you said, like car insurance, is just protection. It's not it's not a necessity because it's likely never to be needed during those years. The great thing with whole life is it's a permanent policy. They can't take it from you. It doesn't end until you die or live to be 121, and they're going to give you the money one or give it to somebody out, that you're connected to, whether it be you or after you die to your beneficiary. So, it's still going to be there. I'm not saying don't think about the protection that it provides, but yes, this financing thing. And I'm going to bounce a little bit, Doug. It'd be fun to try to figure out how you get this in the title of this episode. But this same woman that I spoke with talked about, that she was still contributing to her 401k, though, it was about the match, but she has a husband who just retired from the police force, and he has a pension and he has a 403b, kind of like a 401k. And when he retired, he had a whole bunch of sick time that he hadn't used, which they then go and pay out to you, right, at your going rate, what they were paying you probably as an hourly thing. And she got this big lump, or he got a big lump sum of money, and of course that got added on to their income for that year. And so then they had this big tax bill. Well, of course, they had some money to pay for it. They just got this lump sum. But her thinking, which is not crazy, it makes, I guess, some sense. She decided to increase her contribution a tax deferred contribution to her 401k, because she says, I don't want to get hit with all these taxes. Right.
Sure.
And I said, well, you're kind of just extending this thing that you don't like. You're upset that you're paying taxes or too much taxes. So let me defer them. But all you've done is deferred them. You've only pushed them down the road. You're still in that game with them. So
Right.
but you're going to give them more of your money that they can eventually, if there's profit, they're going to tax, right?
Sure. Of course.
Well, even if there's no profit, because they're saying, hey, we deferred the taxes. Now you want the money at some point in your life, and you're going to pay whatever rate we tell you. But the fact is, you're talking to me right now about this concept that if you pay the taxes today, whatever growth you have, which you will have growth within these policies, and you want to use any of that money, you will never pay taxes again on that money.
Mm-hmm.
Isn't that something that your mind says, I don't like this concept of them taking and taking and taking, but I'm actually going to give them even more so they can take even more. How about no?
Yeah.
Try to connect the dots for yourself, right? That yes, I want to get out from under. I'll pay now, and I'll never pay again, and that's so. It's just this, as he says, it's because of this mindset, and it's mostly mindset that's been programmed into us, and we didn't know that there was another way.
Correct.
And there is. And she kept saying, there's got to be a better way. That she had been when she started going down this road of learning about different things and financial things. And of course, well, yeah, you've landed on certainly one of the better ways. And,
Ta-da!
yes. So.
Yeah, well said, John. I think we should probably wrap up, as this surprisingly has turned into a pretty long episode, but I kind of lost track of it.
Okay, sounds
yes.
good. All
Well,
right.
thanks, everybody, for listening.
Yep.
And we'll talk to you soon.
Sounds great. All right. Talk next week.
Bye.
Bye.
Thank you for joining us for another episode of the ABCs of IBC.
If you enjoyed listening, please hit subscribe and leave us a 5-star review wherever you listen. It really helps. See you next week.
Bye.